Welcome back to CNBC. You're watching Trading Matters. Well, we're going to get the regional market action with Sejal Patel, but first of all, let's flip things around for a change to get the final score on Australia's market with Matt. Hi, Matt.
Hi, Mandy. Thanks very much for that. The Australian market managing to finish to the upside. The S&P ASX 200 higher by 0.2% at the close. It's a gain of just over 8 points, 4,540 the level for the market, 45.59 the high of the day, 45.18 the low point. Now let's get up to Singapore and how the market's looking around the region, Sejal.
Yeah, Matthew, we are seeing some pretty nice gains from most of the markets. Now, Japan is a little bit of a laggard, but remember, it was closed for holidays yesterday, so we might be playing catch-up to the softness that we saw in the markets yesterday. Do want to stick with Japan there. Nikkei up about 0.2%. Fast retailing, one of the biggest contributors to the market, and this is after its Uniqlo casual clothing chain, its sales surged 35% in October, so real bounce back in that stock. And also we'll be keeping an eye on a number of autos as well. Toyota, there was a newspaper report that it could increase its global production by 13% this fiscal year. Also a separate report saying that they could pull out of the Formula One race, and we could hear that announcement today. So something we're keeping an eye on. As for Nissan, the third biggest automaker in Japan, set to report results today. Net profit estimated to come in around 9.8 billion yen. So we'll be watching for that. That would be an 87% drop from the year before. As for South Korea, the banks there have been really rallying. I think the key thing here is we heard from Shinhan Financial yesterday, KEB, both reporting better than expected results. Net interest margin also better than expected, and loan provisioning costs, those expenses, down quite a bit. So it does show that these banks are recovering nicely from the global financial crisis. As for the Greater China region goes, just want to mention Hong Kong PMI coming in, shooting up to 54.6. So it does show that growth is accelerating in that market. It looks like employment also ticked up. That's been helping the market in general. The Hang Seng Index up about 1.6% in general. We're seeing gains in a lot of the gold stocks, blue chips higher as well. And on that note, Mandy, I'll send it back to you.
Sage, thank you so much for that. Well, with the last of the major banks reporting today, it is safe to say Australia's top banks have managed to safely navigate through the financial crisis. A PwC report shows the four major banks' underlying cash earnings only slid 2.4% to $17 billion for the 2009 full year. The lenders saw strong growth in net interest income and financial markets revenue, but also saw a near doubling in bad debt expenses to $13.2 billion for the full year. Well, this chart shows the average ratio of bad debt expenses to loans and acceptances hitting 0.76% this year, which is the highest level since 1993. Well, joining us for more on the bank earnings season is Mike Codling, banking and capital markets leader at PwC, who also helped author this report. Mike, I understand you believe that we may have reached the peak in the bad debt cycle.
Well, I do believe that. I mean, there's lots of uncertainties, but I was pleased to hear Gail earlier in your show. We formed the view because undoubtedly we think bad debt write-offs are going to increase next year, but we think a large part of that will be covered by the provisions. We think the provisions are reasonably healthy, and we see that the economy as recovering now, and so you put those two together, and we think the evidence is that bad debts will moderate. But I have to say there's still some dark clouds out there. We could be wrong, but the sense is very much that in the next year and certainly beyond, we expect bad debt expenses to fall.
Yet I'm wondering, I mean, it's easy for us to say in general all of the banks have seen their bad debts peak, but every single bank has got slightly different exposure. For example, Westpac has a little bit more exposure to the more stable home lending market. ANZ obviously has more exposure to the recession-hit New Zealand. NAB has more exposure to business lending, and therefore NAB says it might take another 6 to 12 months to be able to definitely say the bad debt cycle has peaked. Are you seeing that delineation as well?
Well, I'm not sure, I apologise, but I can't be drawn on bank to bank. But I would say I recognise those differences, and I'd say across the industry we are tending to see a tail down in the level of new accounts that are hitting the workout groups. We're seeing that the consumer portfolios are not under as much stress as we thought they might be 6 months ago. Unemployment hasn't hit the rates that we thought it might do. And on that basis, we are reasonably confident to say that we think bad debt expenses will tail off.
Mike, looking through your report, you seem to indicate there that increasing regulatory capital, increasing solvency requirements, and also the need to fund deposits with expensive wholesale funding is going to limit the ability of banks' profit to grow and limit ROE going forward. What do you see sustainable ROE really being for the sector?
Well, it's dipped, as you know, down to the lower teens, and whilst ever there's the increased capital requirements, and whilst ever the banks feel the need to demonstrate the strength of the balance sheets, that will put some pressure on their ability to grow ROE. Having said that, there is a fair amount of potential upside on cash earnings. We see, as we've already talked about, bad debts coming off. We see that net interest margins are likely to increase through this year. So we do expect that there'll be a recovery in return on equity, but potentially not in the short term, certainly up to those levels that we saw through much of the mid-90s and early 2000s.
Let me come into you, Peter, here. I've got a question for you as we head into the Christmas season. How much of an important indicator do you think that is going to be as to how the banks will also fare? Because obviously consumers are still going to be hurt a little bit by the fact that we've only just come out of a bad economic cycle. Rates are now on the rise. The share market seems to have stalled a little bit in its market rally as well. Are these things that you see hit the banks?
It's the first litmus test for what Mike's saying. So we'll see. The Christmas retail trading season is very important as an initial test. I think the banks are going to fly through. It's going to be still a reasonably strong retail season despite some of those various factors you've mentioned. There's a lot of spending out there, and I think the retailers are in for a good season, and the banks will sail through. But later in the year it gets harder. Who knows?
Later in next year, you mean? Into 2010, you think the headwinds are gathering?
That's where the uncertainties are for me. I just don't know about the pace of the recovery. We've had it so good, so quickly.
Mike, I have a question for you. As obviously interest rates are going to be on the rise. I mean, we really don't know at what pace and to what level will it eventually end up. But do you see there any necessity for the banks to hike rates more than the RBA is because of that still lingering funding gap?
I suspect there will be some pressure. There's certainly, I suspect that, the competitiveness within the deposit market is going to only increase. That already this year put pressure on the margins to the extent of 18 basis points on average, which was recovered through increasing lending rates. There's a couple of other clouds on the horizon in terms of just funding. The banks may need to hold additional liquid assets because of some new potentially new regulatory rules, and we just don't know what's going to happen internationally. It's good to see Warren Buffett showing confidence in the US market, but it's far from certain how quickly that will recover. It's not out of the question that we could have some hiccups in the wholesale credit markets, and that would bring pain back to Australia.
Indeed, we are not completely decoupled, are we? Thank you so much for joining us today.
Pleasure.
Well, before we head to the break, let's have a quick look at the US futures. The indices are suggesting we might have this kind of open, a moderately positive one. We'll be watching the Fed statement when it releases its decision on interest rates. Not looking for any change to interest rates, but we are looking to see whether they change their language, whether they become more hawkish. We'll also look for earnings out of News Corp, Time Warner and Cisco. Also taking a look at commodities, oil has edged back a little bit following the API data. It's currently sitting at $79.36 a barrel. And as we mentioned, spot gold hit a record high above 1,080 a troy ounce. It is sitting at 1,083 right now. The Australian dollar also fell back after disappointing retail sales data locally. It is sitting at 90.28 US cents right now. Up next, one trader recommends buying a media play that has grown rapidly since signing a deal with Foxtel. Plus, our guests will name their top buys across all sectors on the Aussie market. Stay with us. We're back right after this short break.
This program brought to you by the Lexus GS460 and GS450 Hybrid. Two exceptional cars, one very difficult choice.
One body, two souls. Lexus GS460 V8, Lexus GS450 Hybrid. Two exceptional luxury cars, one very difficult choice.
Spring into action this November with Lifestyle. Are you ready to sell? Mary gives the biggest gift she can in Mary, Queen of Charity Shops.
How much are you doing for charity shop?
Not that much, but maybe now I will.
The adventure of a lifetime begins in the real Swiss Family Robinson.
It's tougher than I ever imagined.
Spending time with your family is a lot more important.
The Locators, reconnecting lives and reuniting families.
Well, you had to know you had a mom out there somewhere.
Get down and dirty with Grime Fighters.
I think I found that for things.
It is pretty bad, isn't it?
And we continue to give your green fingers a workout.
Put your pots into position and then add the soil. So this November, spring into action and see what's possible on Lifestyle.
On the next Worldwide Exchange, something for investors with an appetite for Central Europe, with a focus on the Hungarian economy from the capital, Budapest.
And it's decision day for the Fed. Will the central bank give any more clues about its exit strategy?
And we'll discuss the impact of the yen on Nissan's results.
Start trading currency with FXCM, the official sponsor of the CNBC Currency Challenge. Sign up today and receive a $100 bonus. FXCM offers no requotes from dealers and over 30 market indicators. Visit fxcm.com.au for more details. The Currency Challenge update is brought to you by FXCM.
You're watching Trading Matters. Thanks for staying with us. Let's get an update on the CNBC Currency Challenge. Overnight, Hassan Shaheen cleaned up. He picked up around $4 million to edge ahead of Paul McCurry and into the top spot. Meantime, Peter Hocking is back in third place. Well done, everybody. Just a reminder, there's plenty of time to win that Alfa Romeo. Trading continues for another 5 full weeks before the finals get underway on December the 14th. Just go to the website, www.cnbccurrencychallenge.com, and try to clean up yourself. Well, time now for our trader's tip. Here is why one broker has his eyes on BSA Limited.
The stock that I have for you today is BSA Limited. A large part of BSA's business is installation of pay TV for Foxtel, as well as other services for Telstra, Ozstar and Optus. Their partnership with Foxtel is now in its 11th year. The balance of their revenue comes from building services. In what was a challenging year for most companies, net profit after tax was down 3%, which equates to earnings per share of cents, and the dividend was also increased and is 2% for the year. Based on current prices, the stock trades on a PE of around 6 times and a fully franked dividend yield of 8%, which I think is good value.
We should mention that Adrian does have holdings in that stock. Let's get back to our guests for their final picks. Gentlemen, we've already talked about Telstra, and you both like Telstra. Peter, tell us about your other two in your basket of top tips.
Well, the other two large caps are CSL, where it's been downgraded on currency issues. So much of its earnings are offshore and in US dollars. I think that's partly mistaken in that they're buying blood plasma product for Europe from US, and they've got the currency advantage and the strength of the euro relative to the US dollar. Gardasil and Influenza are great long-term investments for them, great products. There's still significant earnings growth there. They're halfway through a massive buyback of their own stock. That not only underpins the price, I think it's cheap. And Woolworths is just quality, quality, quality. Australia's best retailer. Come back from 30.5 to under 28, it's cheap.
Not well for nothing then.
Not well for nothing.
What about you, Sean?
Look, I quite like media at the moment. I think it's got great leverage to economic recovery. It's been led into the cycle very early, and it's got great earnings potential on the upside. So News Corp's the stock there, a very big, lot of liquidity.
We've got the earnings tonight, don't we?
We've got the earnings tonight as well, and you know, Rupert's been reasonably upbeat for the last couple of results, so we might get some more good news out of him.
And Pacific Brands, just really quickly?
Pacific Brands, it's a retailer, very much a turnaround story, recapitalised, debt under control, taking costs out and benefiting from strong currency.
Wonderful. To both of you, thank you very much for joining us today. Peter Burrows from Bell Potter and Sean Fenton from Tribeca Investment Partners. That does it for us today on Trading Matters. Make sure you tune in tomorrow. We'll discuss where to find the best investment opportunities on the Japanese markets. See you then.